Hello everyone, thank you for attending this course. Today we will start learning for screening-based sustainable investing strategies, including positive screening, negative screening, norms-based screening, and themed screening. Due to the easy-to-implement nature, screening-based strategies, especially negative screening, have been dominating the market for decades. Let's move on to the agenda. This chapter consists of three parts. Since this is the first lecture on sustainable investing strategies, I will start by briefly introducing the history of socially responsible investments, and followed by the brief history of the definitions of the four screening strategies and their corresponding market conditions. Then the second part contains a detailed analysis of four research papers published in renowned journals utilizing either qualitative or quantitative methods. Finally, the third part introduces several investment funds using these screening strategies. So, modern SRIs often claim to have emerged in the United States during the 1970s and early 1980s as a consequence of concerns for non-economic motivates. During the 1970s, as anti-war sentiment rose in the United States, socially responsible investors included companies associated with the Vietnam War. When it comes to the 1980s, their attention shifted towards avoiding companies associated with apartheid, especially companies operating in South Africa. And over the 1990s, social concerns have expanded to include the areas of corporate citizenship. Shareholder theory gets popular. And finally, when we enter the 21st century, the concept becomes more and more inclusive. Companies have to respond to various stakeholders such as the environment, customers, employees, minorities, suppliers, and the community. As aforementioned, there are four types of screening-based sustainable investing strategies, namely negative screening or exclusionary screening, positive screening or best-in-class screening, and the third one is norms-based screening, and finally we have the themed screening, or it can also be called thematic investing. As one of the most popular SI approaches, screening is an investment process that considers the social and environmental consequence of investments from both positive and negative perspective, and also within the context of rigorous financial analysis. The aim of screening is first, reflect investors' personal value and ethics in their portfolio choices, and second, encourage companies to improve their ethical, social, and environmental performance. And the first strategy we will introduce is negative screening, which is the most popular strategy among European investors. It has two variations. The first one is the industry level exclusion, and the other one is ESG based exclusion. So for industry level exclusion means excluding companies involved in sinful industries, and common criteria include weapons, alcohol, pornography, tobacco, and animal testing. For example, the definition of alcohol screening is the exclusion or partial exclusion of companies involved in the production, licensing, retailing of alcohol products, or manufacturing of products necessary for production of alcoholic beverages, as well as the ownership of or by an alcohol company. Besides the aforementioned popular exclusion criteria, investors also start considering more specific issues like rainforest, old growth logging, and intensive animal testing. In terms of market condition, as of 2020, Negative screening, representing over 90,000 billion assets under management, is still the most popular sustainable investing strategy in Europe. From a global perspective, the exclusionary approach is losing its momentum. From 2016 to 2020, the growth rate of negative screening shows an inverted U-shaped curve, so the net growth rate is nearly zero. The second variation of negative screening is ESG-based exclusion, and fund managers can apply negative screening through cleansing stocks with bad ESG rating. This approach usually serves as a secondary screening. The aim is to avoid companies that belong to ethically accepted industry but perform badly in other criteria like supplier and employee relations. The second strategy is named positive screening or best-in-class approach. So it requires investors to pick those companies that have the best ESG score in a particular industry sector. So for example, best-in-class funds focus on rewarding companies with good environmental and social track records relative to their industry. Compared to industry-based negative screening, this results in a lower industry concentration, and this can mean selecting the least bad businesses in some sectors. It can motivate companies to ethically challenging sector to improve. The prominent disadvantage of positive screening is that insufficient diversification may lead to underperformance. The table lists the three top ESG performers in each industry. Investors utilizing a positive screening approach can still invest in controversial industries, for instance, oil, mining, and traditional automobile manufacturing, but only in companies with top ESG performance, such as Anagas in the oil and gas industry and Kumbang Iron in the metal and mining industry. And also top the overweighting of top ESG performers and underweighting of poor ESG performers can motivate companies in ethically challenging sector to improve. The size of positive screening is relatively small in all the major markets. This is mainly caused by the concern of under diversification. However, the market share is growing steadily year by year. The third screening strategy is norms-based screening. And norms-based screening is an established method for making investment decisions. It examines whether potential investment comply with global standards. These standards commonly include environmental protection, human rights, working conditions, and measures against corruption. Global standards are set on the basis of various principles. These commonly include OECD guidelines for multinational enterprises, UN Global Compact, and guiding principles on business and human rights. This table shows four important social norms and their corresponding regulating global standards. For example, in terms of labor rights, companies must refrain from using child labor and forced labor and protect union rights. These aspects are covered in both UN Global Compact and OECD guidelines. So norm-based screening ranks the fourth in terms of assets under management in the European market. However, its market share is declining over time compared to ESG-based screening methods and norm-based screening using rather narrow and limited criteria compared to holistic ESG-based screening methods. The last screening strategy we will introduce is theme screening or sustainability themed investing or thematic investing. And thematic investing is characterized as a top-down investment approach that capitalizes on opportunities created by macroeconomic, geopolitical, and technological trends. These are not short-term swings, but long-term structural transformative shifts. For instance, the best For instance, the heat of investing in alternative energy is fueled by several global trends like energy demand surging, limited supply of fossil fuel, falling cost of renewable energy, and security of fuel supply and climate change. The following graph compares the energy consumption landscape between 2018 and future 2040. To sum up, fossil fuels will still dominate global energy consumption. However, renewable energy like solar, wind will increase by over 300%. This provides investors an incentive to dive into this market with potentially high growth rates. Meanwhile, the cost of producing renewable energy declined rapidly over the last 10 years. For example, the cost of producing solar photovoltaics declined by 82%. And all in all, the potential high growth rate and declining production cost sparked the rapid growth of thematic investing. So from 2016 to 2020, the total assets under management increased by over 600%, representing the highest growth rate among all 7 strategies. And this is the end of history and definition parts of this chapter, and we will continue with the paper analysis part. And as aforementioned, the second part of this chapter consists of detailed analysis of 4 research papers. And the first paper named Do Socially Responsible Investment Policies Add or Destroy European Stock Portfolio Value? And this is written by Benjamin Auer, and who utilized the classic portfolio sorting strategy to investigate the financial impact of negative screening. And this paper illustrates the process of implementing an active screening strategy. As aforementioned, this paper used a rather conventional method to construct portfolio. However, instead of using commonly applied ESG measures like SFO and Bloomberg, the author picked sustainability ESG scores, a rather novel ESG rating at the time of writing this paper, and which gives us a different reference regarding ESG measures. Therefore, through using the novel ESG rating provided by Sustainalytics, this article examines whether negative and positive screening approaches add or destroy value in terms of European portfolio performance. So first, data. As illustrated, ESG data came from Sustainalytics, a global leading sustainability data provider. Basically, they construct time series of separated environmental, social, and governance scores for a wide range of companies. The investment universe is a Euro Stock 600. Research period is from June 2004 to October 2012, and stock return is measured on a monthly basis, and the author used investment universe as a benchmark. Finally, the main risk-adjusted return measure is a Sharpe ratio, which is calculated as a following formula. Then we move on to the methodology. So the paper conducted both negative screening and positive screening. The baseline negative screening excludes the worst 5% of the stocks in terms of ESG rating. The remaining 95% of stocks will be constructed as an equally weighted portfolio. The constructed portfolio will rebalance when ESG rating changed. And also tried with 10%, 15%, and 20% of the cutoff rates, and finally disentangled environmental, social, and governance ratings were also applied to investigate specific effects. In terms of positive screening, the procedure is the same as negative screening. However, the cutoff rate is rather big, ranging from 40% to 90%, since the aim is to use only top performers. The paper utilized a t-test to check whether screened portfolios significantly outperform the benchmark. To avoid the influence brought by non-normality, autocorrelation, small sample biases, this paper also implemented a bootstrap test. The results. The following table synthesized the main results of the negative screening. First, the portfolio contains only companies with ESG rating, or it's called rated only portfolio, outperforms the benchmark portfolio. Which means if a company has a ESG rating, they usually outperform a company with no ESG rating. And second, when using environmental and social pillars as sorting criteria, only a 5% cutoff rate provides a significantly higher Sharpe ratio. However, when compared to the rated only portfolio, the significance disappeared. And then the governance-based sorting manifests clear and better results. Not only are the Sharpe ratios of all cutoff portfolios significantly higher than the benchmark, they are also significantly higher than the rated only ones. And finally, combined ESG score-based sorting also shows some significant results. Irrespective of the cutoff rates, screened portfolio significantly outperform the benchmark. So the conclusion and remarks. The overall results of this paper show that through investing in socially responsible investment, investors can achieve higher financial performance. In the meantime, reflect their values and beliefs on sustainability. In terms of negative screening, excluding unrated stocks provides significantly higher performance. Within the rated universe, only governance screens provide significant higher gains, and environmental and social screens do not eliminate the benefits brought by the simple rated only screen. When it comes to positive screening, rising cutoff rate initially tend to increase portfolio performance. However, concentrating on the very best stocks can destroy performance because of under-diversification. And the second paper, named Socially Responsible Investing and Investor Perspective, is written by Thomas Berry and John Jankus, who designed a survey to investigate investors' preference on various sustainability-related criteria. And given the growing importance of socially responsible investing, it is surprising that there is no consensus of what the term SRI means to an investor. Furthermore, most studies of this question rely solely on the view of investors who already invested in SRI funds. And this paper takes both investors who have used SRI criteria and those who have not into account, and the aim is to rank the importance of various SRI factors and form a unified SRI definition on the basis of investors' preferences. The survey respondents are members of the American Association of Individual Investors. And the author emailed approximately 85,000 members, and 6% of them, or about 5,400 persons, replied, which representing a 6% response rate. And the respondents were older and wealthier than the median US equity investors, and they are predominantly male and retired. The survey splits SRI criteria into several major categories and subcategories. First, the respondents are divided into those who have used SRI criteria in the past investment and those who have not. Second, they are asked to check which major criteria are considered to be a part of SRI evaluation. And then the top four ranked major criteria are further split into sub-criteria. Then the respondent asks to check which criteria influence a specific subcategory the most. The respondents are also allowed to suggest other subcategories corresponding to the four pre-selected major categories. A total of four open questions are asked for voluntary comments. The author used qualitative data analysis software MaxQDA10 to extract the most frequently used words in these comments, and then each comment is read by multiple readers and coded with one of the four tags, including pro, con, d, and n. And where pro means commitment, they indicating support for a particular action. Con representing the comments indicates negative behavior or against some actions. And D means dependence, means comments emphasize a holistic approach rather than specific actions. And finally, N means not specific response and lack of context to determine or indicating do not know. Finally, the results. The survey generated very interesting results. Top four categories are environment, business policy, company products, and social activism, respectively. As aforementioned, the top four main criteria are split into subcategories, with the remaining politics and religion being added to the social activism categories. Another interesting fact is that since SRI grew out of the desire to invest according to various religious values, and the low ranking for religion is somehow surprising. The graph below shows the top subcategories among environmental factors and business policy factors. For example, investors care more about the environmental performance of company and products' environmental impact. It is also surprised to see the relatively low ranking in the corporate governance factor, given its universal inclusion in both vendor analysis and index building. The subcategories of company products and social activism comply with common sense and social norms. For instance, human rights and product safety are commonly applied criteria in the social pillar score construction. According to the word count in the open questions, the environment and the employees are the two most concerning issues. Meanwhile, based on the content analysis, the majority of investors express positive or supportive opinion on the business policy category, and you can check the results of other category in the paper. Conclusion. So overall, SRI investors are more inclusive regarding the categories and subcategories of SRI than those who have never considered SRI principles in their investments. And investors prefer to consider the SRI issue in a more holistic view rather than using a simple exclusionary approach advocated by most SRI funds. And negative screening cannot fully reflect the investors' preferences since they may not agree with the company treated bad products. Finally, in terms of survey results among both SRI and non-SRI investors, environmental issues takes a leading role, and corporate governance and religious values rank rather low. Now we start the third paper. So the third paper, named "Why Wine is Not Glue: The Unresolved Problem of Negative Screening in Socially Responsible Investing," is written by Simon Decaux and Jeffrey York, who used a case study to prove that negative screening is potentially problematic and a new SI framework is needed. The author argued that current SI offering cannot accurately reflect the values and the ethical beliefs they propose to represent. Moreover, the use of prior criteria is potentially misleading. Here, they refer to using an industry level exclusion to exclude companies in the so-called simple industries. Applying this Florida approach, SRI funds fail to influence the direction of the firms they deem most in need of redirecting, and therefore the author proposed a new holistic framework upon which the SRI screening methodology can be grounded. The paper starts with a brief history of socially responsible investing, and the description is roughly the same as a modern SI history at the beginning of the chapter. If you are interested, you can read the original paper. And the author defined three main methods of implementing SI, and this is different from the seven sustainable investing strategies we are discussing now, but the idea is quite the same. And the first one is social screening, which includes positive and negative screening. The second one is shareholder advocacy through annual meeting and proxy votes. Investors in a firm can theoretically lobby for greater social and environmental responsibility. And finally, we have community investing, which aims to provide financial services to communities lacking them. And since the primary method is social screening, this paper revolves its arguments around the use of negative screening, basically. And then the author discussed the question, do the means achieve the ends of SRI? And the first purpose of using SRI is to enable individuals to invest with their morals. And however, the screening criteria are usually too broad. Over 90% of Fortune 500 companies are eligible in an SR fund, and meanwhile, the authenticity of an SR fund could also be undermined because of individual tailoring. The second purpose of using SRI is to promote CSR practices and sustainability of businesses. Over 75% of the assets held by SRI funds are withheld from alcohol industry, and refusing to invest in sin stocks leads to an inability to change their behavior. Finally, the third purpose is to punish the misbehaved companies. However, companies in the sin industry may also support cultural and social norms in a powerful manner. Small local wineries are striving to protect tradition, culture, and local taste. And then the author used a case about underfinanced local winemaking businesses to illustrate the point that not all businesses operating in controversial industries are problematic. First, is winemaking a simple business? Of course, excessive consumption of wine can generate serious health and social problems. However, this is largely caused by the globalization of taste and irresponsible production, included by big wine companies. And small local wineries are striving to protect traditions, cultures, and taste. And this phenomenon can also be observed in beer brewing businesses. Germany, Austria, and Belgium have a rich tradition of brewing monastic beer, but lack of investment has caused many traditional tastes to disappear. On the other hand, glue making industry is commonly not considered as controversial. However, the resistol contained in H.B. Fuller's top-selling glue caused severe damage to children's brain in the 1990s. Therefore, we can conclude that no company based solely on its industry can be considered to be socially responsible or irresponsible. The author proposed a holistic method of analyzing and implementing SRI. Investors must consider three criteria simultaneously. The first criteria is product impact, which requires investors to understand the social, economic, and psychological impacts brought by a company's products or services on its user. And then the second one is stakeholder relationships. It is important to understand stakeholders' expectations and assess how the company is creating value for them. And finally, contingent environmental criteria requires investors to understand the company's external environment, its own management culture, and the culture of local communities, and other legal, economic, and political aspects that influence its operation. And finally, we have the fourth paper named Ethical Investment Processes and Outcomes is written by Grant Mickelson and colleagues who used a short literature review to highlight the key themes in the field of sustainable investing and identify some of the major theoretical and practical challenges facing by both scholars and practitioners. There is a growing body of literature on ethical and socially responsible investment across a range of disciplines. Understanding better the complexity of the relationship between such investment practices and corporate behavior is one main challenge in this research field. Most of the extent study focus on a narrow set of issues related to SRI. This paper explores the benefits of examining ethical investment as a process. The author discussed four important questions regarding sustainable investing, including who invests in socially responsible investing, how to select ethical investments, does ethical investment pay, and does ethical ownership matter? So you understanding who invests in socially responsible investment is important because demographic characteristics have to predict investment style and to improve client relationship. The paper argues that the individuals who invest in ethical causes are relatively wealthy and therefore can bear financial costs, which means they are aware of the risk of underperformance. And meanwhile, part of the motivation engaging in SRI might be to simply feel good or to fulfill their psychic income. Of course, the main reason should be promoting ESG practices. In terms of the ethical investment process, the paper covers two screening strategies, positive and active screening, which we have learned in previous slides. And if you are interested in, you can read the original paper. The author pointed out two important criteria that investors must pay extra attention to when selecting sustainable investments. First, investors need to ensure that the fund manager manages the fund according to its initial prospectus. Meanwhile, the trustworthiness of invested companies must be checked. Second, most companies may not operate in controversial industries directly. However, part of their sales may be contributed by thin industries. For instance, steel companies may involve in the supply chain of weapon production. These companies should be excluded only when the portion of sales is too high. And finally, when it comes to the financial performance of sustainable investment, previous literature shows divergent results. Most of the research suggests that SRIs provide the returns at least no worse than controversial industries. There is also literature that supports the view of underperformance. They argue that ethical investment have the problems of less diversified and high transaction cost. However, as sustainable investments are accepted by more and more institutional and retail investors, the transaction cost gets lower, and the under diversification problem is relieved because of the expanding investment universe. Finally, in terms of ownership or shareholder engagement, the author argues that the exit strategy is more suitable for firms whose share prices are more sensitive to a changing investment base. On the contrary, large institutional investors tend to use a voice strategy, and invested companies usually act upon their request. Finally, the author draws the following two conclusions. First, SI should be treated as a process. All the connections and adjustment within this process needs to be examined before making an investment. Second, SRI is a complex topic that leads to many disagreements on various perspectives. For example, the mixed evidence concerning the financial returns of ethical funds. And finally, the author also mentioned three problems future research needs to address. First, confusion remains about what exactly constitutes an ethical investment. Second, the lack of consensus about the investor's preference on ethical factors. And finally, the terms of ethical conveys the impression of self-sacrifice and philanthropy, and which hinders the generalization or recognition of sustainable investments. The third part of this chapter aims to introduce a generalized framework for building a sustainable funds portfolio. First, an investor needs to define a sustainable funds universe. Nowadays, you can easily retrieve a list of investable sustainable mutual funds or ETFs from your broker. And then you should consult fund reports, websites, and pitch books, or even meet with asset managers to get a deeper understanding of their investment strategy. And second, sort the funds universe into different categories according to a sustainable fund taxonomy. Here we focus on two categories: ESG consideration and ESG focus. ESG consideration means that the fund considers ESG factors, but sustainability is not their core strategy. On the contrary, ESG focus conveys the information that the fund has intentional ESG focus, and they incorporate ESG in security selection and portfolio construction. And apparently, ESG focused funds have a higher level of ESG integration. And finally, you should select your funds based on your ESG preferences and other financial criteria. For instance, large cap versus small cap, regional versus global, equity versus fixed income, and active versus passive. Meanwhile, you should take transaction costs and administrative fees into consideration. And the rule of thumb is that if it is too much, then it doesn't worth it. And the following table shows some leading ESG consideration funds. And here are some examples of ESG focused funds. So that's the end of this chapter. Thank you so much for your attention, and see you next time.